You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo.
Hey, what's up, Market Moose? Mike from the Moose on the Loose. Hope you're doing well today. Today we are looking at Canoe or Canoe, not too sure. Canoe Income Fund, EIT.UN. It's one of the Canada's largest closed-end funds, offering a monthly distribution of roughly 8.5%, depending on the day. So pretty nice distribution yield, very popular fund, and a lot of investors are asking themselves, well, can I retire on Canoe Income Fund? Especially, if you invest like $1 million, you get $80,000 a year in dividend paid monthly. Sounds like a pretty cool pension paycheck for a lot of investors, right? So let's take a time to dig into it, see if it would be a good fit for your portfolio. So first, you have to understand that this is a closed-end fund. It is managed by a management team led by Rob Taylor, and is like 100%, almost 100% invested in stocks. Sometimes they will use a little bit of leverage. Sometimes they will have a little bit of cash, but most of the money is invested in stocks. So first things first, if you're thinking that it is like a super safe fund, well, be ready to go through some volatility. If you look at the stock price over time, it still goes up and it still goes down as any other fund that focuses on stocks. In terms of sector allocation, the company invested in several countries and mostly invested right now in financial sector, with 31% of their portfolio invested in that sector, 16% in energy, and then it goes down to 14.6% in industrials, about 11% in consumer services. It goes down to 9% material, 9% healthcare, 9% consumer products, and nothing in technology, and 0.85 in communication services. So relatively well diversified besides the high exposure to financial. But one thing that you have to know about Canoe Income Fund is the management team is quite aggressive in its turnover. So this means that they are adding and selling stocks all the time. I've been following this fund for several years now, and just to give you an idea, between the review I did for my Dividend Stocks Rock member in September of 2024 versus August of 2023, there was 9 position out of the top 25 that has changed. So that's a 36 turnover rate. The year before, it was 12 position out of the top 25. And right now, the top 25 holding makes 78% of the fund. So it's pretty much like everything in the fund is in the top 25 if you look on their company's website. So be ready to see a lot of movement. So it goes from like one sector to another depending on when you invest in the company, which could lead to great performance, but also increases the chances of making a bad trade. When I look at the top 25, we can see a lot of dividend payers. In fact, there's only 2 companies that do not pay a dividend, or only one. Actually, I think there's just Berkshire Hathaway on the top 25. So it is like linked to a lot of yield here. Of course, the distribution rate at over 8% is not generated just by the dividend, but also by selling those companies. Among my favorite, you can find Royal Bank, that shows a yield of like almost like 3.7%. Very strong rating at DSR. Visa, same thing. One of my favorite holding in my own personal portfolio. Starbucks, National Bank that I also have in my portfolio. Of course, you know my love for National Bank as well. Intact Financials, another great company with a super strong dividend triangle. Lowe's could be interesting. I prefer Home Depot, but I used to own Lowe's a while ago. Two great retailers for home improvement. Analog Devices as well. That is another interesting pick. Elevance Health and United Health Group, two other companies on the U.S. side showing very strong dividend triangle. So overall, I would say that I kind of agree with my good friend Rob. No, I don't know Rob, but I mean, they're doing some pretty good picks here. And speaking of which, the performance of the fund is reported on their website. So you can see the 1 month, 3 months, 6 months, 1 year, 3 year, 5 year, 10 year, and since inception, which is great because it gives you a good idea of how the fund can react throughout time. The one thing I don't like though is they report their total return, but their benchmark they use is the TSX, so the Canadian market. Ironically, if you look at their asset allocation, right now they have a little bit more than 50% of their portfolio invested on the US market. So it's kind of easy to beat the TSX if you use half of your money to invest elsewhere of the TSX. So I'm not too sure why they selected that benchmark, but overall, even if you look like the real mix, which is like almost like half and half US and Canadian equity with a little bit of international exposure. If you do that mix, investing in like ETFs, Canoe actually outperform like most of the time, which is great. It was not that conclusion I made when I first reviewed the fund in 2020, but between 2020 and 2021, they made a big move investing massively in the energy sector, and they kind of did it perfectly. So at one point, I remember from the top of my head, they had probably like around 30% of their portfolio in the energy sector, and today they're down to 16. So they did a great move. They cashed on their profit at the right time before the situation stabilized, because let's be honest, over the past 2 years, the energy sector is not doing any better than any other sectors. But if you bought anything at the end of 2020 or in 21, then you made a lot of money. And this is exactly how they did it. So kudos to the management team, and that provides some very interesting returns as of late. One thing I want to highlight, though, that could be perceived as a risk is the fund is issuing more units every single year since 2019. So in 2019, they had less than 100 million shares, and today we are close to 170 million. So they almost doubled the amount of shares since 2019. If they are not able to issue more shares, or like there's not enough like investors that want them, the share price will go down, and then it's going to be very hard for them to issue more shares and create that necessary liquidity to pay the dividend. So you just have to be careful with this. That is definitely a downside. This plus the turnover. So you really rely on, I must admit, a strong management team that has been able to perform for several years throughout a lot of different economic cycles. So that's great. I'm going to give that to them. But you just have to be careful, because if they don't perform at one point, it's going to be very hard for them to issue more shares and pay a higher dividend. So they are pretty much stuck in that performance circle, which so far they've been doing well, but I just have like a little bit of concern here. And the other thing is, while the total return is great, that is like the stock price plus the dividend, well, the distribution in this case, the distribution doesn't move. So if you want to retire on that 8%, it's great, but it's not going to move. So how your retirement budget will look like, your buying power will look like in 20 years from now, if you have the exact same amount that you receive today, that could be a problem, because inflation is definitely there. And it's one thing to receive like $50,000 today, but $50,000 in 20 years from now, it's not going to be that much. So you just have to consider this also. So overall, I would say it's probably a good investment to put into a mix of anything else. So it's a good complement to your portfolio. It brings monthly revenue, it has a high yield, and it has performed as opposed to many high yielding solutions. So I would say maybe that's interesting, but just keep in mind that the distribution doesn't increase at all. And the company is kind of stock issuing more shares all the time to pay that juicy dividend. So this is definitely a risk if we go through a severe bear market. So right, Moose, if you want to know more about this one, if you want to read charts, you can head on to moosemarkets.com and you will see it's the latest article that I wrote on Canoe Income Fund Review for 2024. All right, Moose, take good care. Have a great day, and we're going to talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.